Awesome. Yeah, thanks, Spencer. Thanks, everyone. Really appreciate the opportunity to say hello today and share a little bit from our perspective about not necessarily what we do. I didn't want to come in here and make it a serious sales pitch, but more so kind of make folks aware of the various capital instruments, or more specifically, credit instruments, non-dilutive capital that's available to them. I think over the last kind of decade and a half, there's been a real burgeoning of new entrants and new groups into the space that offer a really broad swath of different capital types and credit instruments. And so, our job's to kind of help folks sort through that vast sea of potential options that's available, and align them with the best solutions on the other side. So, without further ado, let me dive in here. I'm traveling right now, so I've got my phone, but I'm going to share from my laptop here. Give me 1 second. And share. Okay. How is that for everyone? Actually, if I can full screen somewhere. There we go.
Yeah, it's good.
Cool. Awesome. So, move. Always fun when you've got a bunch of screens open here. There we go. Okay, awesome. So yeah, thanks everyone for joining. Again, we'll walk through some non-dilutive capital instruments, how to kind of consider these in the framing of your business, and then, if interested, how to actually position your company well, so that you're well received by the credit investors on the other side. My quick background, without getting too much into the minutiae, is I've been in or around the space of private credit for about the past 11, 12 years now. I had a previous venture that I exited from in 2013 that kind of gave way to some organic relationships in this space. And I said, you know what, this is pretty fun. I think I could build a cool business out of this. And so initially ran a marketplace that was focused on traditional small business credit for about 7 years. And then really ever since COVID, have transitioned and kind of moved gradually up market. And, at this time, we're really focused on helping, the broader innovation economy. So think, innovative startups and scale-ups, could be high growth kind of brands, selling apparel, food and bev, and growing quickly. And ultimately just companies, I'd say thematically, that may not fit the traditional mold of a bank, because they're reinvesting heavily into their growth. But they certainly kind of captivate the interest of a lot of growth-focused credit investors. And yeah, that's what we have a lot of fun with, and really enjoy what we do. It's new conversations with founding and management teams every day, and so get kind of a first row look into a lot of different industries and areas, which is always great. And based in Miami, normally I'm down here in Bogota, Colombia for about 4 months. So it's kind of a second home for us at this point, and try and make it down here whenever we can. All right, we'll start out on the negative here. It's the end of the world as we know it. If you're familiar with the song from REM, and I feel fine. So this is kind of where we're at right now. And these are 2 images presented from DALL-E, so a portion of ChatGPT, that are very polarizing in nature. And I think a few years ago we saw a lot of the stereotypical, seed stage or early stage startups raising at perhaps inflated valuations at the time. And comparatively today, I think we've seen a lot of companies that have just been running their businesses differently. And some of that is due to the equity markets kind of shifting, which I'll talk about in the way of these couple graphs. And some of it, I think, is a lot of these founders and entrepreneurs, with the equity markets kind of shifting, are re-engineering the way that they run their businesses to be a little bit more lean, a little bit less capital intensive, perhaps relying more on technology and automation than team. And we're seeing a lot of that in the proliferation of AI right now. Folks that once might have signed a big enterprise software contract saying, hey, I might be able to build this in-house and for, cents on the dollar, so to speak. So I won't dig too far into this, but ultimately, there's comparatively, over the last few years, there's been more down rounds, which is raising at a lesser valuation than they did on the prior round. There's been a lot more kind of interim and bridge rounds, which my interpretation of that is kind of a lot of companies that intended to go out and raise the big rounds maybe decided that they didn't want to do that amidst the way the market has been, kind of communicating with them. And so they raised maybe an interim $500,000 or a couple $1,000,000 instead. And then if you see kind of, a concentration to the right, just a higher proportion of smaller rounds versus in prior years, it was a higher concentration of larger respectively rounds on pre-priced rounds. So this is at kind of the seed stage, but replicated for some larger rounds as well. And then this is something that I don't think has really changed much over the last few years. It's been more of a constant, but specific to equity financing, you still find that a lot of the dollars that are earmarked towards equity fundraisers are going to a couple states, and dare I say, kind of a couple regions or cities in particular. And, you have Boston, Massachusetts, you have the Bay Area, you have Greater New York, and you have some kind of secondary and tertiary markets. But big country, even bigger world, and it just seems like equity dollars are very kind of focused in their own ways. So, so all of this kind of presents to us a strong case for credit. And Spencer or anyone else, by the way, I have a tendency to go long. So at any point, if you need me to wrap it up, just give me a signal and I can expedite things here. But
yeah, Ryan, Hannah, she'll let you know. She'll let you know.
I can appreciate that. So here are some typical use cases for equity and credit. And a lot of what we're seeing is that any kind of good midterm to long-term or mature company ends up throughout their life cycle probably using a blend of equity and credit. Sometimes that's not the case, but that's pretty typical. And so we end up working with a lot of founders who have maybe raised some historical equity, and they're saying, hey, we've raised this for products, R&D, to kind of place some early key hires that we wouldn't have been able to had it not been for early equity dollars to extend our runway and so forth. Whereas credit is generally earmarked for more predictable use cases within the business, because credit naturally is debt. And so there will be ascribed to it a predictable kind of repayment. And so you want to make sure that the things you're using debt or credit for have carried with it a predictable ROI, or at least some use case of ROI. So typically, folks are going to use credit for sales, marketing, maybe sales headcounts, expanding into new territories, purchasing inventory, in general, kind of working capital and capital expenditures. And then I won't get into the minutiae, but and by the way, I'll share this afterwards so you guys can have a copy of this. But generally, the expectations between equity investors and credit investors are pretty differentiated. Overall, the key thing that I want to kind of take into the next slide or two is equity capital can get pretty expensive in the instance of a successful liquidity event. And most business owners at some point want to have a good liquidity event or sell the company. And so it's just something to keep in mind that equity certainly has a diversity of really great use cases, but oftentimes not all use cases. So we'll kind of get into the mix here. This is a really great kind of indexing of various credit investors and lenders that was culminated by A16Z or Andreessen Horowitz, notable equity investor. And if you look here, it's almost really hard to see because there are so many different solutions. And even this is probably 2 to 5% of the total firms that kind of play in this space of, kind of non-bank or private credit. So it really is a huge marketplace, and it can be a little dizzying at times. And so one thing I wanted to do today is just kind of simplify a lot of these different groups and what they care about down to a couple underlying credit themes and how you can appeal to each one of those respective credit investors or types thereof. So when we think about our business at Cirrus, we often describe our offerings or our capabilities in the way of 3 core themes. And the first is revenue or cash flow-based financing. The more modern approach could be, let's take a look at your revenue. How fast are you growing? What does that trend look like? Whereas the more classical approach could be, what does your net profit or EBITDA look like? And can we ascribe a predictable multiple to that to say, hey, your business made $500,000 last year. We're comfortable providing to you a loan or a facility to the tune of maybe $1 million or $1.5 million. So that's number one. The second would be asset-based lending, which covers a lot of different areas. It could cover accounts receivable and inventory. A lot of companies set up a borrowing base against those types of assets. Could cover machinery, equipment, real estate, other hard assets. Could also cover intellectual property or even a patent portfolio. So that's another kind of landscape here that I don't think a lot of folks are aware of. And then the third would be venture debt and growth debt, where they're going to be more so looking at the merits of what equity have you raised to date? When was your last round? What's your valuation? How much cash do you have in the bank? And they care about different things than other kind of traditional lenders because they're almost thinking about deploying capital through the lens of an equity investor, but getting paid back through the mechanism of credits and repayments. And so those are kind of the underlying themes. Here, this is just a screenshot taken from my mobile yesterday. Just a few of the credit instruments that you can think of kind of falling underneath of each one of these themes. And there's even a lot more outside of this, but nonetheless, a lot of great solutions. And then this slide, what I intended to capture was there's a lot of different important underwriting factors. So think of this as kind of a universal slide for what a lot of credit investors are going to care about, if not all, when it comes to each one of these respective kind of criteria. However, as we'll dig into it, some care more about certain attributes than others. And we can kind of dive into the minutiae there. So in the instance that a credit investor is what I would call like a revenue-based investor, revenue-based lender, or a cash flow-based lender, generally they're going to be looking at a couple different attributes or factors here. One is revenue growth, or at least stability in the way of a more traditional lender. They want to see that you're upholding a strong, stable business, that you're growing. In the case of a more kind of traditional cash flow-based underwriting, they want to see that you're profitable as well, because oftentimes the amount of capital available to you can be contingent upon how profitable you are or lack thereof. And I would bifurcate this category of lenders into kind of 2 distinct segments, kind of between, do they care more about the revenue or do they care more about the bottom line? The first category, there are a lot of really great, what I like to phrase as programmatic lenders that can move very quickly. And these are, you might have seen advertisements for one or multiple of these types of lenders, but ultimately their mantra is, they want to offer credit by way of technology. And so their onboarding process is normally pretty seamless. You get a link or a portal and it says, hey, we want to learn more about your business. Why don't you go ahead and connect your various systems of record? Let's get a good snapshot of your accounting software, of your bank level data, maybe some commerce level data that might take place through, say, a Shopify or an Amazon or something like that. And in exchange for connecting said data, you get a really fast offer, or at least indicative terms back to you, which is great. They're also able to work with you in the setting that you are marginally profitable, which is good as well. The subtle trade-off there is it's going to be a little bit more expensive than that of a traditional lender. So you're probably going to be in the low to mid-teens versus kind of the high single digits to low teens like you'd find with a bank or a traditional lender. Common objections and roadblocks here are if the business is not profitable and the forward-looking model doesn't really give the lender a good line of sight into profitability. Or what we often see is sometimes that point A to point B between, hey, we're not profitable, we're burning cash, but we're going to be profitable, hangs in the balance of one kind of key event or milestone in the business, which inherently creates a lot of risk for the lender, because theoretically, if that future equity raise doesn't happen or come to fruition, or if the onboarding of that new enterprise level client doesn't quite take shape, then all of a sudden they don't have a means to collect on their loan or line of credit or the type of credit they're putting forth. So that's a big one to watch out for. The other is I often tell people that you can have a decline in revenue. That's okay, especially if bottom line is lifting and you're running kind of a leaner business with a good cost center ascribed to it. But you can't have a business that is declining in revenue and also declining in profitability or EBITDA margins as well. Theoretically, you can, if you can back it with assets, which is kind of our next class here. But ideally, you want to have one or the other, or ideally both, right? You want to be growing and growing bottom line as well. Unfortunately, that's just not always the case, because if you're thinking about growing top line and investing heavily into the business, inevitably that's going to impact your net margin and your net profit and EBITDA at the end of the day. In the instance of asset-based lenders, oftentimes they're going to ascribe a loan to value, or what we call an LTV, against the various assets of a business. If it's against inventory, accounts receivable, it's going to be often in the way of a revolver or a line of credit for the business that's backed by those assets. Whereas if it's heavier assets, the lender can get comfortable going out over, kind of a longer tenor or term. The reason that I also wanted to highlight at the top here, debt service, is because I think there's a notion sometimes that if a business is in a state of distress, it's not necessarily that capital solutions aren't available to you. And that's a whole other kind of segment of the market, and one that we've been instrumental in. But most of the time, let's see, Hannah, keeping me honest here. 2 minutes, I got you. Let's do it. Most of the time, an asset-based lender is still going to want to know that they can be repaid. They're in the business of making yield on their investment. They don't want to be in the business of having to, sell off things in a fire sale and just try and, get the best value for the assets that are being pledged against that form of a loan. And lastly, again, venture debt, growth debt investors, they're caring about kind of a different set of criteria or parameters. They're going to look at the strength of your cap table, who's on the cap table, when did you last raise equity, how much runway do you have, and so forth. In the spirit of time, I'll move forward here with the last couple kind of insightful slides on how you can really speak to each one of these credit investors, or all of them, frankly. The first thing I'll say is credit underwriting is a lot more qualitative than you think. And you probably heard me mention a couple times, projections or a model. And so there's often things when you showcase your business in the way of its financials or P&L or balance sheet, that gives you some of the story, but oftentimes not all of the story. And the decision for a credit investor to pass or to provide capital or credit is, in many cases, largely weighted upon the projections of a business and what the future looks like for that business still. Credit investors need to get paid back. It's a little bit different than equity. And so you want to show irrefutable proof and kind of confidence that ability to service the debt or the credit is there. you should know your business really well. Have a great answer for every single line item in your balance sheet, your P&L, your projections, so forth. It's worth it to slow down to speed up when you build out your materials. Take time to do this, treat it like a professional process. Start there before kind of engaging in the research process. And these are all areas that we help with at Cirrus as well. And the last thing is, not every credit investor is going to necessarily offer a decline based upon your business. There's other underlying factors too. Maybe they do 10 deals a year. They've already done all 10. Maybe they only want X amount of capital into one specific industry and they already have that allocated. Doesn't mean you have a bad business. And so in those situations, ask for referrals, ask for their peers who might love to offer capital to your business. And I know we're running out of time, so I know there's no way we're going to get through this last slide, but just the key kind of areas here are when you're preparing, slow down to speed up. When you're researching, uphold a very clean and meticulous database and keep track of things like decisions, terms that come across, things like this. And ultimately try to avoid deal fatigue in the process. Keep the overall, I guess, the vibe, positive throughout. And you want a good steward of a partnership continuing, because ultimately you're going to be working with this group kind of on and off for the foreseeable future. And so, keep that in line before it kind of gets into, red line or legal purgatory, and try to approach all that stuff at the very beginning versus having it kind of trudge out. So, I'll stop there. I know I went over, but more than happy to answer any questions. And again, really appreciate your time today here.
It's great, Ryan. Thank you. Can you just go back to that last slide? Maybe people can just be looking at it while we're doing Q&A.
Sure.
So if you got questions, put them in the chat or just come off mute and I'll kick it off. You talked about the qualitative side. How about some best practices for marrying the quantitative with the qualitative when it comes to like telling the story and the presentation?
Yeah. So I'd say that the qualitative is probably going to be dictated by the quantitative, right? Because every credit investor is probably going to want to lead with quantitative. They're going to want to get a sense of the size of the company. Are you profitable? How much cash do you have in the bank? What are your assets, and so forth. The qualitative side, though, is a nice overlayer into that, where you can present in kind of a footnote fashion, hey, what you're seeing within our financials says this, but what it's not picking up is the fact that we're going out and we have a moat around this segment of the market. And because of this, we're going to be able to grow revenue 3x year over year. And here's how that's going to take shape. The qualitative could also be just in the way of kind of, some of this is more quantitative than qualitative as well, but it could be your product in and of itself, right? What do you do that's better than anyone else? In many cases, it's also the management team as well. If it's a strong management team that has a propensity to win based upon their history, and maybe their personal net worth is high as well, they're probably going to be a better candidate versus a business that on its face potentially is better off through some of the more quantitative merits, but might have kind of a team that this is their first foray into the market and they're just new and into what they're doing. So those are some qualitative merits that I say are pretty important to consider.
Okay, I have another question, but I'll be quiet for just a minute in case someone else has a question. I'll be quiet for yeah, go ahead.
Thanks, Ryan, for the presentation. It was truly insightful. The question that I have is from the team's perspective, right? So how much do you think a non-technical founder versus a technical founder for a startup who are developing a new project would impact their growth or venture-based debt equity when it comes to presenting those details to a potential investor?
Yeah, that is really a great question. that honestly, I would say matters probably a lot more to equity investors versus credit investors, with the caveat that venture debt investors in specific are going to apply a little bit more of an equity viewpoint into the way that they evaluate their potential opportunities or portfolio companies. And so, you know, a lot of this just comes down to the presentation. And interestingly enough, you know, at Cirrus, we frequently come across companies that could fall into any and all of those categories. You know, we're helping a company right now that's a hardware intensive business with a subscription revenue stream, and they're profitable and they're growing quickly. So I know I'm navigating around you know, the initial questions you have, but I would say that's more of a keen focus for like venture debt investors. And I think it, you know, honestly, it just comes down to your ability to execute. I think a good technical founder could also be a really great team builder. I think a good kind of visionary founder, or maybe someone from like a business development background, could also potentially outsource really well a lot of the technical elements of other companies. So I think there's a lot of nuances there to consider, and again, just kind of leading with your strengths to that specific credit investor.
Yes. So I think, yeah, like the market that I've been seeing, the most of the responses I've been hearing back. So it's basically from the perspective of equity-based financing. And I see a bit of, you can say, a friction when it comes to, you know, identifying them as a business development and a keen executioner instead of being able to completely develop that technology stack. So there comes a bit of, you can say, friction in that sense, but like we try
And
our
some
best to do that stuff.
That's right, absolutely. And I would say some of it too just depends on the staging, right? I think when the equity investor or potentially a venture debt investor cares a lot about who is on the team and their specific roles, it's probably still pretty early stage. Whereas for credit investor, they want to see some revenue traction. And by that point, they probably have a pretty established product that's gaining some traction in the market. And so it becomes a little bit less about, do you have a product? Are you going to be able to build this product? And more about, what is your plan to diversify into various products and to scale these out in the way of, you know, a growth or a sales plan.
Yes. Yeah, I think that makes sense. Thank you, Ryan.
Yeah, great question.
Another question out there? Ryan, is it ever the case that you're working with a client and they're considering an equity raise, but you know, debt could also be like, do you ever blend and kind of do both at the same time?
Sure. Yeah, in fact, there are settings where a company is raising equity, and in the case of venture debt in specific, where that venture debt investor cares a lot about the cash runway and the liquidity of a company, we'll see settings pretty frequently where they'll put forth a contingent term sheet that basically says, hey, when you finish up your $2 million, $5 million round, we'll close concurrently on the venture debt side of things. So that can be pretty commonplace. We'll also find, yeah, founding teams that are kind of weighing their options and considering, do I want to raise additional equity? Do I want to bring credit or debt into the business? A lot of the times it can definitely be both, and they're very friendly with each other. And as referenced kind of earlier in the presentation, you know, even mid to late stage companies probably have viable use cases for both equity and credit, just depending on where they're wanting to focus at that point.
Okay, that makes sense. Nathan put a question in the chat there. I don't think you missed it, Nathan, but how do you get to non-dilutive capital? Is it as imagined only through debt, with a wink?
That's right. Yeah, these are all synonymous terms. So non-dilutive, credit, debt, kind of use those interchangeably. But yeah, if the credit investor or an investor is not expecting a return in the form of kind of their markup on a portfolio or potential ability to sell shares of a company, then they would make it back through a repayment of some sort in the form of debt. You're exactly right.
Very cool. Yeah, can you go back to the slide that has your contact info then, and we'll wrap it up here.
Yeah, for sure.
Awesome. Thanks, Ryan, for coming out and sharing with us today your experience and knowledge. It's been great. And here, everyone, you can see how to connect. I found you on LinkedIn also, so I know that's a place you're active. And it's great. So thanks for coming out.
Thanks as well. Really appreciate it, and excited to get to know you guys a lot better as well.
Awesome. Thanks, everyone. Have a great rest of your Tuesday.
Thanks. Take care.
Thank you.
Thanks,
You
Ryan.
too.